Welcome to the daily update, where I'll go over the action in the market for Friday, November 28th, and we'll see how things look for Monday, December 1st, last month of the year. And it's been a pretty positive year up to this point. Things are looking fairly positive right now. We have to go with price. That's the ultimate indicator, but we're still seeing a real underperformance from growth, and that's a bit of a concern. The market is not really on offense right now. It's not like anything's really falling apart, but when we look at our ratios between the two, growth still continues to underperform. And that's not what you see in a real positive environment. So we had a really solid up week and we bounced out of the lows that were set in the previous Thursday. And we've been up pretty strong since then. We're not at new all-time highs with the S&P. We're not very far away from that either. We'll see now after the holiday weekend. The smart money should be coming back. The volume should pick up. Folks will focus more on the market. And there's really two scenarios that are driving things right now is that there's probably going to be a rate cut in December. At least that's what the market's thinking. Now, remember when Jerome Powell came out and said, we're not so sure about that. And then a number of Fed officials, at least on the FOMC, came out and said the same thing. And then about a week ago, that started to shift and it started to be more dovish. And the market really likes that. And inflation doesn't seem to be a real big problem. We're starting to get economic reports again. Earnings seem to be looking pretty good. And so there's optimism that's really in the market right now. We're still extreme negative as far as sentiment, but that continues to improve and that could actually work to the market's favor. Okay, so as we enter into December, I'm thinking about just opening up my whole website. Just you'll have immediate access to the videos, other videos that I make available to you. Just kind of make it like a free month here. Now I'm going to be locking that down in January. This is the scenario that I'm going with the program that I have here. So feel free to check that out. And you do have to provide an email address, but if I unlock everything for the month of December, you don't need to provide payment information and you'll have access to everything. So see if this is something that will be useful to you, and you could set up a time to talk to me if you would like, and we'll just kind of work together and see how I can help you in any form in that regard. Okay, so right at the open, it was a sleepy day. Not really, I mean, it's Black Friday and it closed early. So the market really didn't show an awful lot of conviction. If anything, it was leaning more to the positive side. We ended up with a higher open. Now, before the market opened, there was a problem with the futures. The CME, I was trying to follow it and it was just stuck on the same price. And then I saw later on there was a headline. So they had some kind of a glitch that took down the system for a while, but it ended up not being that big of a deal. But we did end up having a higher open. We got above R1 at 68.36, and we just kind of stayed there. We held on to the gains and we closed slightly below the 68.50 level. So now that's the round number that the market is dealing with. And we're looking fairly positive currently. So for Friday's session, we were up 0.54%, way below average with volume. Not a surprise there. And we are positive on all three time frames, short, intermediate, and long term, because we're above the moving averages. We did tick back up a little bit with the 10-year yield, but that doesn't seem to be all that influential right now. But we always want to keep an eye on that. And then, of course, it's a holiday weekend, and there's all kinds of geopolitical things going on, but we'll just see if any of that ends up bleeding through and having an impact on the markets. All right, some comments. Growth continues to underperform. I'll show you that. We've been talking about that now for quite some time, and it's continuing, and that's a bit of a concern. It's a market that's getting more defensive, and we'll see if things end up shifting as we're coming back into the upcoming week. And then the rate cut optimism for December, it's continuing to build. And I'll go over that again in the weekly video. We still have in the background, and this is negative, that's how we get the name, Hindenburg. There's this thing, the Hindenburg Omen. It's still back there. It's still valid for right now, and it's negative. And so we'll see. There's also another one that isn't quite there right now. Now, this is a positive signal. It's called the ZWAG NYC breadth thrust. I'll show you that chart. We hit the negative part of that signal back when we had the big down Thursday. And we've been coming up, but we're not at the trigger yet to generate a ZWAG NYC breadth thrust. So that's still in the background. It still has time for it to work out. It needs to become extreme positive by December 5th, which is this coming Friday. And if that happens, that could be quite a positive signal. But we can't count on that until it actually happens. Where the Hindenburg Omen right now, it's confirmed and it's been there going back to October. And so we just need to respect that. And then on a short-term basis, still seeing a little bit of a continuation of building of the short-term momentum that's looking positive. We're starting to look extreme now, but that also shows positive conviction when the bigger picture is positive, which it is right now since the long-term trend is up. We have the StochRSI Williams percent R, and these are the usual charts that come up here when we're showing good short-term momentum. We don't have the CCI charts on here. We do have the stochastics. They've been improving. And then we had a pretty solid up week over the last 5 trading days. If you go back to last Friday, because this past week only had 4 days, really 4.5, but 3.5 if you want to just count Friday as a half day. But the rate of change going back 5 periods, that means we've gone up pretty fast here. And doesn't necessarily mean we're going to reverse, but we just want to be aware of that because we have gone up pretty fast in a short period of time. And there may be a point where folks want to come in that are more shorter term and start taking some profits. And now we're starting to get too far away from the 20 period moving average. That's the short term way that I measure whether we're positive or negative. Intermediate term, we have the CMB composite. It's looking extreme. Now, these are more overbought type conditions, where in the short term, I'm looking at more as more momentum in that case. And then the PMO studies, that's been on the list for a couple of days now, starting to get extreme there. And we're starting to get extreme positive with the McClellan Oscillator for the S&P, where we're seeing an improvement in across the S&P itself, and now it's starting to give us a pretty extreme positive reading. No real change. If you've watched these videos before, the it's still looking like the market anyway is anticipating there's going to be a rate cut. Now, Monday evening at 8 p.m. Eastern time, Jerome Powell is supposed to be giving a speech, and this is going to be after the market closes, and we'll see if anything comes from that. If he turns a little bit more dovish or if he stays more hawkish like he did after the last Fed meeting. So you know what's going on here. I mean, they came out and they were more hawkish, and that was sending the market lower. And then some folks came out and said, "Well, we might be open to a rate cut," and that has helped the market bounce back up. So we'll see if he throws anything to land it either way, or if it's like, okay, we've heard all this stuff before. Then the dollar was down. That's also been helping stocks. We're back under 100. We've been under 100 now for the last few trading sessions with the US dollar index. And since it declines, the market likes a weaker dollar. And interest rates are up a bit. Now, we actually ticked just a little bit under 4% after Wednesday. Now we're back up over 4% after Friday at 4.02% with the 10-year yield. We're still extreme negative here. We're at 24. We have to get back up to 25 to get out of that extreme negative territory. Now, when we had the big down day, we got all the way down to 6, and then we went up to 11, and then it was 14, and I think it was 16, and then 18, and now we're back up to 24. So the context is that we are improving. And as I said, when folks are really pessimistic about things from a sentiment standpoint, we can use that as a contrarian indicator. But there's other charts that are saying maybe we're a little too exuberant right now. And then we're still not trending, even with the update. The ADX is still below the moving average. We're positive. The green line's above the red line, but we haven't really shown, either in the short or intermediate term, any real conviction enough to turn the trend to getting stronger. And with the update, the bias is positive, and I'm keeping it mixed to positive. We are positive now as far as the momentum. We had a really solid up week. What's keeping them mixed here, in my opinion, is that growth is underperforming. And it's not falling apart, but it's underperforming. All right, so we didn't have any economic reports, and then we're gonna start getting some reports in the upcoming week. I, for this past week, in the past couple of weeks, I've just ignored the whole thing because we didn't know what was coming out and what some of this data was old, and I'm gonna try to pick up on that again. I've got the calendars prepared later on in the video and I'll try to follow along with that. All right, so looking at the real investment advice here, we're seeing a bit of a disconnect. The deviation of earnings either above or below long-term growth trend and valuations. See how this is really going up here, and we've actually been coming down when we're looking at the deviation here, and then the PE ratio here is in black. And so this is a bit of a concern. Yeah, we're overvalued, and if we do start going down, that's the first thing that'll come out. The market's overvalued. It's like the catch-all excuse, but we are getting a bit far apart here. And then what do we look at as far as presidential cycles? And there's been enough time and enough research done on this to say, okay, we should probably pay attention to this. We're still in a post-election year right now, and this is a second-term president, even though there was a gap in between the first and second. And this tends to perform fairly well. And then coming up into the other times when we tend to perform better, but still the post-election year just typically does do pretty well. And this goes all the way back to 1950. Okay, and then equity positioning here, just right about at the middle here, just a little bit under zero right now. So, and this could work in the market's favor too. It's like you got a lot of folks that aren't really trusting that the market should be going up right now. And if we continue to go up from here, they're going to have FOMO, the fear of missing out, and more likely to jump in. And then this compares discretionary, where folks try to actually look at the market and analyze things, versus those that just follow a systematic approach. They maybe don't really pay attention to what's happening with the overall market. They just like do their dollar cost averaging and they have a system that they follow and they really don't deviate from that. When we were coming down, both of these were taking a bit of a hit, but we've been bouncing back up. With the discretionary folks kind of coming up a little bit quicker because they've been, okay, we're seeing some bottoms here. We're seeing some charts turning more positive. So it's actually been coming up a little bit quicker than the systematic approach. And then cumulative sector flows going in here, and most of the money still goes into tech, and where we're actually seeing money coming out of financials. And that's another thing. We've been continuing way back to last spring, seeing where the financial sector is still continuing to underperform the S&P. And it hasn't really led to anything. We've just been keeping an eye on that, but that's not what you would see in a more solid environment. But that's been building now for a number of months. And then we've been seeing a real push into healthcare. That was the strongest sector in November. It was just under 10% for the month. My goodness. And that's also a defensive area. And you saw some folks probably taking some profits in Friday's session since it had a pretty good run there. And so it's good that it's doing better, but at the same time, it's like it's a defensive area, so we're a little bit concerned about that. Why is it coming on strong all of a sudden? And then in the weekend videos, in the intermarket video that I do, I'll be comparing the financial sector and the healthcare sector to the S&P itself. I go through and do some ratios that way. All right, so it was a pretty sleepy day, and we did have a higher open, and we got above R1. We stayed above R1, then had a little push going into the close that took us just under the 68.50 level. And you can see going back, this was when we had that big down Thursday, and that's about where we bottomed. And we've had a pretty nice run just up and to the right here with how we've been bouncing up since that time. And it's really helped to improve things. It was a holiday week, though. We want to be a little bit suspicious of this. We don't want to just assume that things are going to continue to go up, even though we look at our charts and they are still looking positive. And then here's the intraday chart. And things were kind of flat here for a while. Of course, we had the holiday thrown in the whole mix here, and there really wasn't much data coming in, but we did close just about at the high now that we are set from a stock market perspective now to close for the weekend. And this is another underperformance that we're seeing, and we've been seeing it for a while. Now we're coming back up. We're just about at a new all-time high when we look at the intraday chart for large cap value. That's red. And blue, that's large cap growth. It is underperforming. It's going up, but it is underperforming. And we didn't really see much of a change here with our intraday growth to value ratio for the S&P. I mean, it was actually down a little bit in Friday's session. So on an end of day basis, where growth was up about half as much, a little bit more than that, than when we look at large cap value. And for the mid caps, growth did outperform, and growth was up slightly for the small caps, where it was unchanged for value for the small caps. So we are improving here on our end of day chart. We were really coming down there. We've crossed back below the 50-day moving average with small cap growth to value, and now that's been improving. We're still not really improving all that much here with mid cap growth to value, and we're flat right now. To be going up and to see the movement up here that we've been getting out of the market, and to see this actually going down and at best just going sideways, it's not. We just want to be aware of this. Growth usually outperforms value when the market is really strong. Now, one thing that does seem to be looking better is I've been trying to point out where we had the high, then we set a lower high, then we were setting lower highs. We might be breaking out of that. It looks like, because if you put like a line down here, we're starting to break above that, and that could end up being positive from that perspective. And we were unchanged here with this growth to value ratio as well. We're actually down a little bit. And discretionary to staples, just not doing all that well right now. Not falling apart, but not showing any real leadership either. And so we're not trending. We're still below the moving average in the short term. We're flat here, but we are positive with the green line above the red line. Also below the moving average in the intermediate term, but the green line is above the red line. And we saw a big drop off in volume, not a surprise in that regard. And then looking at some sentiment gauges here, we're coming down. Now, the market was taking a bit of a hit as we were going down. This is a little bit longer term, and it uses a lot of different things that it puts together. So this tends to lag a little bit here, I mean, we're still looking negative even on the daily side, the quicker charts, but they are improving. And we're still above this moving average here with the Ulcer Index. This is an end of day fear gauge. And we continue to drop. This is positive. The VIX is below 20 and declining below the moving average, both with the line chart and the bar chart. And we're dropping down with the volatility of the VIX as the VIX has been coming down as well. We ticked up a little bit here with this fear gauge, which on an up day is a little bit of a surprise, where we're still declining with this fear gauge. So a little bit of non-confirmation there, but not anything really big. We saw a big drop off here with the equity put call ratio. So, it's not a lot of hedging as we head out to finish the holiday weekend here. We're going down with the 5-day chart. Now, this didn't update. I waited as long as I could, but we've been really coming up with the 10-day chart. And this is more negative when this is going up. But if we go back to the 5-day chart, the fact that this is declining, that's more positive in the shorter term. And then we're going back up now with the risk on to risk off ratio. That's positive. And the bigger picture is that we were going up and we started to pull back here. We'll be watching this in the upcoming week to see if this continues to go up. And we're also improving with the high beta to low beta. Bigger picture, it's been positive. We pulled back. Now it's going back up. And we're dropping down below the range here. Now, from this perspective, the volatility risk premium sees fear coming out of the market. And we're setting an all-time high with the advanced decline line based on price. I mean, that's positive in and of itself. We're not quite there yet based on volume. So price is outperforming volume slightly on this chart. And we're looking okay. We're positive with the advanced decline ratio. The blue line is short term. The red line is intermediate term. We're above zero and going up here with the advanced decline oscillator. That's positive. And of course, Friday was such a weird day because it was a half day. We're still seeing more highs than new lows, and we're going up with the 5-day chart, and we're trying to go up here with the 10-day chart. So internally, yeah, we're looking pretty good. But it's the rest of the S&P that's been performing better, more of the value areas. We want growth to really kick back into gear and really lead the market higher. Now, our smart money indicators, all three are positive. We're above the moving average with the longer term accumulation distribution. We're positive with the boom indicator. Now, when we get it up to this red line, that's sometimes it's like, okay, maybe we're getting a little overextended here. So we just want to be aware of that. When we've actually gone back to full blown positive with the Chaikin money flow, we were negative but improving. Now we've switched back to green and the red line's going up. That is positive, and we continue to go up above the midpoint with the Chaikin oscillator. That is positive. So all three are positive there. And then we did switch over and we continue to be positive with the vortex. The green line's going up as the red line's going down. And we are setting a new high here with the cumulative advanced decline line for the S&P based on price. Not quite there yet based on volume. So again, we're seeing another indication that price is leading volume. Typically, it's more healthy when we see volume leading price. But again, that sometimes ends up being a big deal and other times it isn't. And we're improving here with all of our advanced decline lines. We're above the moving averages with the NYC common stock, S&P, mid caps. We were flat with the small caps, but we're still above the moving average. And here, the stocks in the S&P above their 20-period moving averages, really looking good. Now, if we get up to this 80 level, that's when we're starting to get extreme. Now, one thing that is positive, though, is I've been pointing out, we were setting a series of lower highs here as we were going throughout the spring and into the summer. We could be breaking that again here. And so this is actually looking more positive. And we're above 50 and going up. Also, kind of right about at this, you could say we're breaking above that when we look at the lower highs here, but we are positive in the short term with the 50-period moving average study, trying to show some improvement here with the 100 moving average study. We never did drop below 50 with the 200 moving average study, and that's continuing to go up, and that is positive as well. So we're coming up a little bit above this pivot point here for November. Now we're going to start watching the pivot points for December. We're positive we're above the 50-day moving average. We're in an uptrend, but not surprisingly, we are way below average with volume. And then showing some improvement here with the 20, 50, and 200 moving averages here. Now this has been coming up. We saw some short-term gains, so we'll want to keep an eye on that. We've moved pretty quickly here. And then the StochRSI, that's showing positive conviction in the short term. And we're also seeing that with the Williams percent R. We are improving, but we're not quite extreme with the CCI 14 above the midpoint and going up with the CCI 20. Now, the short-term stochastic is starting to get extreme, but it is positive. Also starting to get extreme with the intermediate short term, and we've turned back to positive, but we're still below the midpoint here with the long short-term stochastic. And the force index is positive and not really extreme right now. It's not up to the upper Keltner band here. And we are improving in the short term with the 10, 20, and 30 moving average studies. We're above all three lines. The lines are starting to turn up. If the green line, which is the 10, that moves the quickest, if it could cross and get back on top, that would be even more positive. But the fact that they're all turning up is positive in and of itself. And we are improving with the short-term trend based on 20 periods. We're above both lines. The green line and the blue line are going up, and we're coming up out of the rainbow here. The longer we stay above this, and if we can continue to go up, the more of the short-term lines they'll start to even out again and show more of a sustained uptrend. And this is the rate of change going back 5 trading days here. So we've made a pretty big move in a short period of time. And we're coming up into the +2 channel now with the standard deviation chart. That's still positive. When it starts to look extreme is if we get up into the +3 channel. Intermediate term, balance of power above the midpoint and advancing. That's positive. Here's the CMB composite. We're above this upper black line here, and that's looking extreme. And we're trying to turn back and look more positive here with the go, no go, with the lighter blue bars. But these things change colors and then they redraw. So we'll just see how it tries to figure things out here. We're coming up above the midpoint with the highest high value chart. We're not quite up to the blue line, which is the highest high value. And we are improving. We're actually positive, even though we're still red here with the TTM squeeze, but we're coming up. If this continues to go up, eventually it will turn blue and it's lighter red. So that is positive. And we're, according to this chart, 0.61% away from the all-time high on a, excuse me, on a closing basis here. So we're less than a percent there. And we're still moving pretty quickly here with the standard deviations chart. This measures speed, it doesn't measure direction, but we've been going in one direction now quite a bit, and that's why we're getting a high reading here. And we're just barely turning positive with the ease of movement after we had been drifting down and looking more negative. We're still negative though with the Arum, but this indicator can sleep for a while. We have the buyers uh, dropping off a little bit. The sellers, that's the red line dropping off, and then the oscillators, the difference between the two. And here's where we're looking a little extreme with the McClellan Oscillator for the S&P. We were also seeing a series of lower highs here. We may have broken that now. So in the short term, we're looking positive, and in the longer term, this is turning back and looking more positive. So we're still going up with the summation index based on price and volume. And we're positive, but we're not extreme with the NYSE McClellan Oscillator and possibly breaking this series of lower highs as well. So we're going up with the summation index based on price and volume for the summation index on the NYSE. Positive with the Swollen Trading Oscillator, advancing based on price and volume, improving but not quite switching over to positive. But we're switching over to positive now with the momentum. But here with the PMO, we're not quite back up to the moving average. But when we break it out based on price and volume, we are positive. We've crossed back above the moving average, trailing a little bit here with volume, where we're breaking out a little bit stronger based on price. And this is the PMO study that's looking extreme. The PMOs that are rising, we're above this 80% level here. So it's positive, but sometimes when we get about to this level, it doesn't necessarily mean a reversal. It just might mean that we could slow down. We are above 50 and going up with the buy signals. That's positive, and we're going up with the PMOs that are above zero. Positive with the Elder's Impulse system. Positive with the parabolic SAR. Turning positive with the short-term oscillator, the slope oscillator. We're above the moving average and going up. So that's positive. And we're starting to cross above the moving average and trying to cross above the midpoint here with the MACD. That's short to somewhat intermediate term, turning back to positive. So we are looking positive here in the short term. We're improving and possibly turning positive in the intermediate term. We're still negative the long term. These are longer term oscillators, so takes longer for them to switch direction. We are turning positive with the Copic curve. We're crossing back above the red line. And we're positive here with the Sean trend meter. We're above 50 and going up with the money flow, and we're above 50 with the ultimate oscillator. We're looking positive here, setting a new all-time high with on-balance volume. And we are turning back positive and looking more positive in the short intermediate term with the RSI. We're above 50 with both. And we're above 50 and climbing with the bullish percent index, positive with the NYSE bullish percent index, crossing back above 50 with the NASDAQ 100 bullish percent index. And that's positive itself. And we're improving with the intermediate term trend based on 50 periods. We're above the blue line and the red line. And we're above all the moving averages. That's why we're positive on all three time frames, short, intermediate, and long term. And just in case you don't believe my chart, we're back above the 50-day moving average according to this Bloomberg chart. And we're getting kind of far away, though, from the 20-period moving average. That's what the boom indicator measures, price in relation to the 20, 50, and 200 moving averages. We're positive with all three, but we're getting kind of far away. That's when we use this like an oscillator, and we're getting a reading above 100 right now, but it could still go higher than where it's at now. And then as far we're looking good with the weekly chart here. We were up 3.73% for the week, well above this R1 pivot point. Now we're going to be seeing, can we get up to this R2 pivot point, which may act as overhead resistance. One thing that I was pointing out, which may be in the process of being negated, is each one of these bars is a week, and we were seeing higher highs and higher lows. That started to break down. We could be getting that back now. So that could be a positive development as well. And we are positive with the Heiken Ashi, positive with the Kagi chart, positive with the Renko chart, positive with the three-line break chart. So all the different ways that we measure the trend are positive currently. And we had just enough of an upward move going right into the close to get up to the 68.50 level. So now we're seeing another green X here with the point and figure chart, which is positive. Then long term, looking good with the 150 and 200 moving averages there. This is the ZWAG NYC breadth thrust back on November 20th. That's when we had an extreme negative reading. We have until December 5th to get up to this red line again. So we still have 5 trading days for that to happen. We'll see if that ends up being triggered. That would be quite positive. And you can see other times when this was triggered, what happened after that with the S&P. Now, since we're at the end of the month, we have a monthly TTM squeeze chart. Earlier on, this was actually turning dark blue, and I showed that in a couple of videos. We've now turned back to the lighter blue, so this is looking positive longer term. Positive on all time frames with all the different indexes. We've gone back to being in a downtrend with the dollar, still in an uptrend in the intermediate term, and still in a downtrend with the long term with the dollar. And the only sector that ended up being down was healthcare, and that it had such a good run in November, there was probably some profit taking. But energy, that's a more defensive area, and that was up the strongest. Where tech and communication, they were up, but they did underperform, and discretionary was up, but it wasn't one of the real leaders. Everything was green here, where we had the Nasdaq having a bullish MACD crossover. That's positive. We're seeing that develop now with the S&P itself. We had a bullish MACD crossover with the industrial sector because things are looking better economically. And the Nasdaq got above 23.3. Canada set a new all-time high, and then we had a BPI cross above 50, even though it really performed well in Friday's session. And Nvidia was a bit of a drag here. It ended up being down. Microsoft was up slightly. Apple was up a little bit here. Broadcom was up where Oracle was down. So not a lot of strength, but a lot of green here in the other tech stocks, and that's positive. Financials are showing some improvement. And then healthcare, especially Eli Lilly here, took a bit of a hit after having a nice run. And discretionary did better with Amazon up, but Tesla wasn't up all that much there. And you can see the staples were pretty much green. A lot of green going on here, except maybe healthcare because of the profit taking and a little bit here in tech. So we're looking okay now with the Dow. We're above this pivot point to start out the month of December. If we're above that, that's more of a positive take on the chart, and we're above the 50-day moving average. Positive with the Elders Impulse system, and we're right up to this pivot point for November, which is acting as overhead resistance for the NASDAQ. But we'll start out, unless we have a big gap down on Monday, we'll start out above the pivot point. That's more positive when we begin December. So, and we're positive with the Elders Impulse system for the NASDAQ. We're also right at this pivot point, which is acting as overhead resistance, but we'll probably start off the month above this pivot point, which would be positive as well. Positive with the Elders Impulse system. And a change here. We are switching over and looking positive now with the momentum for the NASDAQ 100. And we came right up to this pivot point with the S&P 600 small caps, and then we closed well off of the high. They were virtually unchanged on the day. We'll have to see if something develops there. We're just kind of at the high end of where we've been before. And then we look at the Russell 2000 small caps. We were up 0.59%, a little more strength there, climbing back above their 50-day moving average. The RSI is above 50, and the MACD is positive right now. Positive with the Elders Impulse system for the small caps, and up 0.45% with the mid caps, back above their 50-day moving average. And positive with the Elders Impulse system. And Wilshire, a broad market measure, above its 50-day moving average, continuing to go up, but not back to all-time highs. Also above the 50-day moving average with the total U.S. stock ETF. And this is encouraging. I mean, it's not like growth is falling apart, but we're not setting new highs here, but we are positive with the FANG index, Facebook, Apple, Amazon, Netflix, Google, Nvidia. So this is still holding up for right now, but we need these guys to come back in and take a real leadership role if the market is going to switch over and be more offensive as we head into the end of the year. So Apple was up just under 0.5%, doing pretty good there. After bouncing off the 200-day moving average, Amazon has now climbed back above its 50-day moving average. And bouncing off the 200-day moving average with Microsoft, it would have been getting hit there. There were all these AI concerns that they were spending all this money. Those seem to be getting alleviated a little bit currently. We'll see if they resurface in the upcoming week. And Google was virtually unchanged, but still looking pretty good. And Meta not back up to its 200-day moving average, but it was up 2.25% and still under the 50-day moving average with Nvidia. And it was down and it put a bit of a drag on things. And just below the 50-day moving average with Tesla up 0.84% and Netflix still under both moving averages. It was up 1.36%, but it has a ways to go just to get back up to the moving averages. If that doesn't happen pretty quick, we're likely to see a death cross pretty soon. And this is interesting. We saw a bit of a contradiction here with the semiconductors. The Dow Jones Semiconductor Index was down just slightly, but it's above its 50-day moving average, where the SMH Semiconductor ETF, it was up 1.3%. So that's why we follow different things here. And it's above its 50-day moving average. And this is a weekly chart of the Dow Jones Semiconductor Index. Even with the slight decline on Friday, we're still above that 100% level when we measure the distance from the 200-day moving average. And this is where we sometimes look toppy. But we've been here. We get above it, then we go a little bit below it, then we go even further above it, then we come back. So it's not falling apart. This is just something that we want to keep an eye on. And we're back to looking pretty good here with the semi to tech ratio that had been pulling back. Now it seems to be coming back in and improving. And oil is up. We're into the mid 59 range now, and the dollar is still continuing to be below 100. And we're just a little bit above that 4% level now with the 10-year yield. But we're not really improving here with our growth to value ratios. Still under a declining moving averages here with the Qs to S&P, and we're just on top of the moving average with discretionary to the S&P, and we're still declining when we compare large cap growth to value. We want to see this going up. All these lines, we want them to go up, and we want the moving averages to be going up as well. Now, it's not the end of the world. It just means that the big growth stocks right now, anyway, are not really taking a firm leadership role. We'll see if that changes as we go into December now. And we're still below the moving averages here when we look at large cap growth of value, mid caps underneath. And we're back actually above the moving average when we look at small cap growth of value. And then here's the Hindenburg Allman if you need to look at the criteria here. And I just use this as a reference because stock charts, they combined all the criteria into one thing here. We don't have another spike here, but we had the initial spike back on October 10th, and now we've had additional spikes since then. And as I've been trying to point out here, we saw this before the COVID crash, and we saw it right at the end of 2021. So we'll see if so far, it really hasn't developed into anything. We'll see if it changes. All right, so the outlook for Monday is that we are positive on all time frames, and we're going to be getting, and again, this we'll have to see how close we stick to this calendar. I tried to cross-check it across multiple sources here. Now, this isn't the real big one. This is the S&P Global Manufacturing PMI. That's on a global basis there. It's important, but I usually only focus on the numbers, whether we're above or below 50 with this report. Construction spending will be coming out. This is the big one, ISM manufacturing. And that's a huge deal. And we haven't had this report in a while, so we'll have to see how this comes out. And then at 8 p.m. Eastern Time, Monday evening, Chair Powell will be giving a speech. And then anything geopolitical, there's lots of geopolitical things going on, but what actually has an impact on the market has been a bit minimal lately. Now, this is supposed to be the economic calendar for the upcoming week, and it's pretty packed. So, and we're going to be getting more data. Now, they've already said that the employment report, which should come out this Friday, is going to be kicked down the road a little bit there. But we got a lot of other stuff, and some of these reports we haven't seen in a while. So we'll have to see how the market reacts to this. And then here, looking at the economic calendar as well. This is the other calendar that I use, and just to see how the two line up. I get it from briefing.com, and then this chart is at investing.com. And Edward Yardeni also goes through the economic calendar as well. Excuse me here. Now, switching over to December, looking at the Stock Traders Almanac statistics. If you remember way back to January, we were up. We were up 2.7%. And we keep that in the background. A lot of people, they make a big deal out of it at the time and then they kind of forget about it. I've tried to keep it on this particular slide to remember that's still back there. And the January barometer, again, almost a year ago now, it's been correct 83.8% of the time going back to 1950. And we were up 2.7%. So that suggested that from a statistical standpoint, we should have a positive year. Now, unless we just tank, we're in December, we're probably going to have an up year here. And then the best 6 months that began back in November, and now we're continuing through as we get into the new year and into April. Now, looking at December over the last 74 years, we've been up 74% of the time and down 26. That's pretty good. That's strong seasonality. I'll deal with the options expiration as we get closer. Now, looking at just for December 1st, we're neutral to negative with the Dow and S&P, where we're neutral to positive with the Nasdaq. So not much of a real edge that way statistically if we just go back to 2002. And then now here's the calendar for December. We're kind of flat here during a post-election year, but we tend to see a bit of a move up here as we go throughout the week. And again, see lots of question marks here. It's like, we're getting the jobs report? No, we're supposed to get it later on. And then CPI, is that going to be coming out? So we do see some general positive seasonality early on before we see some weakness. But where on a seasonal basis, where the real strength comes is as we come into right before and right after Christmas. And then sometimes we call this the January effect, the Santa Claus rally, whatever you want to call it. And now looking at the first half of December, it does okay, but it's not really the best performing time. Where the second half of December, that tends to be near the top end of performance going back to 1950. And as I've been showing over and over here, we do have positive seasonality according to this chart. And dropping off a little bit here, but we do have positive seasonality. Pretty soon this chart will come down because this is a number of days since the Fed made their announcement. And this also shows positive seasonality into the end of the year, as does this chart, as does this chart. So I got lots of evidence. We just need the market to figure out what it wants to do and show its hand on things. And then I don't have the updated chart here, so I just blocked out the December statistics. Not as strong as November, but still fairly solid. Just it's been the past 10 years, the green area, that is what has underperformed, but all the other areas tend to do quite well. All right, so the warning signs, pretty short list right now, which in and of itself is a little bit of a concern when we have everything more tipping to the positive side. We're still concerned about this short-term growth to value ratio and the discretionary to staples ratio. Think back on the charts. They are underperforming, and that's not what you see in a real positive environment. But yet we have lots of other charts that are looking quite positive right now. And then we have this Hindenburg-Ullman that's still kind of lingering behind us here. Our three smart money indicators are positive, and longer term, we're still in uptrends. Well, we're going to lose that unless things change pretty soon. And the McClellan Oscillator and Summation Index for the S&P and NYSE are positive, looking a little extreme with the S&P McClellan Oscillator. And I've just put this over on the positive side. We're starting to lean more positive with the momentum oscillators, and they're continuing to improve. The ease of movement, another new addition to the positive side here, the Swirling Trading Oscillator, which has been positive for over a week now. The parabolic SAR is positive. The bullish percent indexes for the S&P, NYSE, and NASDAQ 100, those are positive. The Vortex is positive. And I have the key over here. The reason why these are gold is I consider that to be a primary indicator. Then we have the money flow and ultimate oscillator. They're now above, both of these are above 50 and they're positive. And for the first time in quite a while, we have the NASDAQ 100 momentum over on the positive side. The financial sector is in an uptrend, but still underperforming the S&P. I'll be covering that in the intermarket analysis video. And then the long-term special K oscillator continues to be positive. There's a daily and a weekly version. They are still positive, even though the daily chart has been weakening a bit lately. And then here are the pivot points for Monday's session. Here. So our conclusion, really haven't changed anything. We're improving as far as the momentum in the short term, but we're still not trending, but we are positive. Also improving in the intermediate term, but we're not trending there, and we continue to be positive in the long term. Thank you. Have a wonderful weekend. I hope you had a wonderful Thanksgiving and a happy Black Friday, and I will talk to you in the next video.